So you're thinking about investing, but the moment you start looking into it, you're hit with this hurricane of advice, right? Hot tips, opinions, everyone telling you what to do. Well, today, we're going to cut through all that noise. We're going to find the simple, clear principles that actually work.
And look, if you're feeling overwhelmed, you are not alone. It's totally understandable. You're getting bombarded from every direction. Social media, the news, maybe even your uncle at a family get-together. It feels like everybody has a secret, and somehow they all contradict each other.
You hear this one all the time, don't you? This idea that you can perfectly time the market. Get in at the absolute bottom and then sell at the very peak. It's sold like it's some kind of shortcut to getting rich. But honestly, it's pretty much a fantasy.
And then, on the complete opposite end of the spectrum, you get this advice. You get these fearful voices telling you the stock market is just a big casino and you'd be way better off just keeping your money stuffed under a mattress.
Oh, and of course, you can't forget the hype train. The pressure to jump on whatever the next big thing is. You got to get in on this new crypto. This tech stock is going to go to the moon. It's just a recipe for confusion, and for most people, it leads to doing nothing at all. But what if I told you the big secret to investing success isn't really a secret? What if, underneath all that confusing noise, it all comes down to a few timeless ideas that act less like a crystal ball and more like a compass, something to guide you on your journey? Okay, so let's start with the most important principle of all, and honestly, it's the one most people overlook. Before you even think about what to buy, you have to get your own psychology right. Because guess what? Your biggest enemy in investing isn't the market, it's you. It's your own emotional reactions.
I mean, this slide really frames the entire battle every single investor has to face. On one side, you've got fear and greed. Those two emotions are a tag team that almost guarantees you're going to buy high when everyone's excited and sell low when everyone's panicking. But on the other side, a plan, patience, discipline. That's what protects you from those gut reactions that can absolutely wreck a portfolio.
This famous quote from Benjamin Graham, Warren Buffett's mentor, just nails it. In the short term, the market is just a popularity contest. It's all about hype, what's trending, what's getting votes. But in the long run, it becomes a weighing machine, where the actual value of a company is what really matters. The key is to focus on that long-term weight, not the daily votes.
So what does this actually look like in real life? It means avoiding these traps. It's greed, right? Chasing some crazy return that makes you take on way too much risk. It's panic selling, where the market crashes and you sell everything at the bottom, locking in your losses. And it's short-sightedness, being glued to your phone, watching every little price tick, instead of focusing on your goals 5, 10, 20 years from now.
Okay, so once you get your mindset right, you need a blueprint, a plan. This isn't about trying to find that one magic stock that's going to make you rich. No. It's about building a solid, resilient portfolio that can handle whatever the market throws at it.
And the absolute cornerstone of that blueprint is a word you've probably heard before: diversification. It's actually a pretty simple idea with a really powerful result. It just means spreading your investments around so that if one area takes a big hit, it doesn't sink your entire ship.
I mean, you've heard this 1,000 times, right? And for good reason. It is the perfect way to think about diversification. If you put all your eggs in one basket and you drop it, well, you know what happens. But if your eggs are in a bunch of different baskets, you're protected.
Now, there's a fancy academic name for this whole thing. It's called modern portfolio theory. But you don't need a degree to understand the point. The goal is simply to create a mix of different investments that gives you the best possible return for the amount of risk you're comfortable taking. It's about building a smart system, not just throwing darts at a wall.
So how do you actually do it? Well, this slide gives you a great roadmap. You diversify across different types of assets, like stocks and bonds. You spread your money across different industries, tech, healthcare, you name it. You go global, owning companies here at home and internationally. And even within stocks, you mix it up, with big companies, medium ones, and small ones. It's this layered approach that creates real resilience.
So you've got the right mindset. You've built your strategic blueprint. Now for the final and maybe most crucial piece of the puzzle: execution. Because investing isn't a one-and-done thing. It's a consistent process over many, many years. You got to remember, it's a marathon, not a sprint.
And one of the most powerful tools to help you run that marathon is called dollar cost averaging. Think of this as your secret weapon against trying to time the market. It's a simple, almost robotic approach that basically automates good investing behavior.
And check out how simple it is. Step 1, you pick an amount of money you can afford, say $200. Step 2, you pick a schedule,
like the first of every month. And step 3, you just do it. You ignore whether the market is up or down, you just invest that money consistently. When prices are high, your money buys fewer shares. But when prices are low, that same $200 buys more shares. See how that works? Over time, it smooths out your average cost and takes all the guesswork out of it.
And here's why that's so important. Brian Walsh from SoFi puts it perfectly here. Of course, we all want to buy low and sell high. The problem is, almost nobody can actually do it consistently. So instead of trying to be a psychic, just be a disciplined investor. Those recurring contributions are how you harness the market's long-term power.
And if you need one more reason to avoid big risks, just look at this number. It is brutal, but it's just math. If your portfolio drops by 50%, you don't need a 50% gain to get back to even. You need a 100% gain. You have to double your money just to get back to where you started. That's why playing defense is so important.
Okay, and one last little piece of maintenance for the long haul, rebalancing. So let's say your plan is to have 60% in stocks and 40% in bonds. If stocks have a great year, your portfolio might drift to being 70% stocks. Rebalancing just means you sell a few stocks and buy a few bonds to get back to your original 60-40 target. It's a disciplined way to sell high and buy low, and it keeps your risk level right where you want it.
So after cutting through all that noise, what are we actually left with? It's not some secret formula or a hot stock tip. It's a compass built on 3 golden rules to guide you.
This is it. This is your path forward. Number 1, master your own mind. Get emotion out of the equation and be patient. Number 2, diversify your strategy. Don't put all your eggs in one basket. And number 3, invest for the long haul. Be consistent and stay in the game. These 3 things, working together, are your foundation for building wealth.
You really don't have to be lost in all that financial noise anymore. You've got the fundamental principles, that's your map. And you've got the 3 golden rules, that's your compass. So the only question left is, what are you going to do with them? What's your first step?